Good morning, John. How are you, sir?
Hey, Ryan, I'm great. Good morning to you.
Looking forward to this conversation. I was super excited when Wendy reached out and she was like, hey, she was listening to the podcast I did with Dave, and she's like, we got to get John on the podcast. We talk about corporate divestitures. You got a different flavor for M&A, the place that you've been playing in. And after 340 some podcast episodes, I'm like, I don't think we've covered that. So like, what a great idea. So
Awesome.
I appreciate you being here. And for the listeners, why don't you just give a little of your background, how you ended, kind of the Cliff Note version, how you got to Prairie and what you've been doing prior to joining Prairie.
Sure. So I've been at Prairie for about 2 years, but I've been doing sell-side mergers and acquisitions work for, dare I say it, getting close to 30 years now. I've worked at some bigger firms and some smaller firms. I guess early in my career, I really learned how to do this sort of work at a firm that's now called Lincoln International. Got about 800 people. And here we have about 60 people in total doing sell-side M&A. I should say 60 people in total in the firm, about a dozen or so of us that work on mergers and acquisitions type transactions. And just to put the context on it, generally we work on transactions that are about 100 million in value and below, although we've certainly done larger transactions than that.
And when you're talking about just for the listeners too, the 12 people, you're talking about the sell side of like third party, because you guys are a big ESOP shop, right? Is that
right?
So you're
right.
talking when those people are devoted to selling to third party entities that are outside of the ESOP,
right? So in total, we'll do 50 transactions, maybe 60 transactions a year. A good portion of those are on the ESOP side.
Got it. It's awesome. So let's jump into your background, because you had a unique spin to where you came from and where you've played in the M&A space over the last 30 years, correct?
Yeah. So when I finished graduate school in 1995, I actually moved overseas into southwestern Poland as part of a program that was part of the State Department. Huh. And I bring that up a lot lately because of the war in Ukraine. I was
very relevant. Yeah.
Yeah, it was only about a 2-hour car ride or 2-hour train ride, probably maybe 3, from the Ukrainian border. And it was just after the fall of communism.
Wow.
So I think I've got kind of a unique perspective on some things from that after spending the year in country, as we say. But when I came back from that, I started working in mergers and acquisitions, and I've been doing it ever since.
And do you want to jump right into like what is a corporate divestiture? I mean, even like, because when I say that you've been playing in a different space in the M&A, I think a lot of people think of, a business owner or owners want to go sell their company. If it's not an internal, they go sell it to a third party strategic or private equity firm. And that's kind of, from the listeners, if they're selling it, it would be like that. Or they, a lot of people think about a strategic buyer or private equity firm and kind of just stays there. But you've been playing over in this area where people are divesting or selling a division or a company or something that's just, I think a lot of people that would be tuning in aren't familiar with that space. So
Sure.
You want to maybe give us a little bit of color on what kind of just set the landscape?
Yeah, so maybe there's a handful of different types of transactions. And, I'm kind of talking about my world. There's other things in different worlds. But in my world, like you were saying there, Ryan, there are transactions where it's, privately held company. Maybe it's been in the family for a decade or 7 decades. And you think about selling the business, and yeah, you'll contact private equity or a strategic acquirer. We can come back to define what a strategic acquirer is. And that is a company sale. We do that all the time. It's a very large portion of what we do. What our discussion today is really about is corporate divestitures. And you can think of this as a situation where it's a bigger company. Maybe it's General Electric or Amazon or, anybody. It really could be. And they have a business or a business unit or a product line within the company that for whatever reason, and we'll get into these reasons, they said, this isn't part of our core. We should divest this business. And that's what I mean by a corporate divestiture, where they're a bigger company's taking a portion of their business and selling it to a third party.
That's awesome. And let's jump right into those reasons if that's the next logical route that you want to go. Because I think what one of the things I'm hoping is that the listeners can get a peer into the mindset of these individuals and the stakeholders that are involved in this, because it's so outside of the peripheral, view, or of the view, it's in the peripheral of a lot of the people that are listening in. So like, what are the reasons? Like, why would how do they come to the conclusion of we don't need this, especially when there's so much M&A activity going on where people are trying to acquire? How are they getting to those decisions?
Well, what I first like to think about is, and I always want to step back and say, why do people buy and sell businesses anyways, just generally.
Great place to start.
Yeah. And let's look at it a little bit from the corporate divestiture perspective. Really, if you're running a company, you have to make a lot of decisions around a lot of different things. One of those things is capital allocation. Where should you put your money and where should you put your time? And sometimes it says, we're going to invest in this area because it's got a good potential return for it. But we have businesses in this area that don't have a good potential return. So those become the things that you think about divesting. And it's not always as clear cut as you might think. And I'll just give it, I try and give examples as we go through this discussion today. Let's say you're a company that makes, and then this comes from an actual transaction that I did, that makes, say, really large industrial sewage systems. And you sell these things all around the world. And when you started doing this 100 years ago, literally 100 years ago, one of the important aspects of it was being able to make this part. Let's just call it part A. And so you set up a factory that made part A. And part A went into these bigger systems that get sold all over the world. Well, time moves forward, and it turns out that anybody can now, 100 years later, make part A. It's not that hard to make part A. It's hard to make the big system. And further, you realize as a company that's making these big systems that get sold to municipalities, you've got a better chance of selling one of these systems to a municipality if you're buying something from that municipality. And I'm not talking about, South Bend, Indiana. I'm talking about, Vietnam, France, all over the globe. So you make the decision to say, why don't we, instead of building part A ourselves, source part A locally all around the world, and that'll help us get more sales in that region, as an example.
Oh, cool. Yeah. Totally tracking you.
So that's an example of a company, and this is a transaction that I actually did, where we sold the business unit that made part A.
Super cool. So how you even started that story, John, I think is an capital allocation, time and money. And as we continue to have the mantra on the show, and what we do is view and run the company as an asset. So bigger companies are always viewing it from that lens, right? They're not it's just where's the return on the overall structure? So they're looking at all the divisions through that lens, probably pretty rigorously. And so then what are the conversations internally? Who are those department heads that are having those conversations at this C-level suite? Maybe it probably depends on the size of company too, but how do those introductions happen, and are you facilitating those conversations to get them to that conclusion, or do they come to you and here's what we're doing?
You said there, as you were kind of doing the intro a little bit, that companies are having these discussions all the time about what they should be selling or not. And I hope they are, but I fear that many of them are not. It's hard to step back and say, we really don't need to be in that business anymore. Let's sell it. But I will say the companies that do have those discussions, and this is going to get into a little bit of data that I've done some research on, the companies that do have those decisions or those discussions and are frequently, as I say, fine-tuning their portfolio of assets, those companies outperform other businesses. And when I say outperform, I'm talking literally about the stock performance of those companies. If you're what's referred to, it's a report by Bain and Company. They do it every couple of years. If you're a company that frequently acquires businesses and divests businesses, those companies tend to get a higher rate of return than companies that don't do that. And a high rate of return than companies who make, say, one big acquisition and one big divestiture every couple of decades or every couple of years. It's the ones that are the little ones moving their portfolio back and forth all the time that tend to do really well.
It's oh yeah, that makes a bunch of sense. And like you said, it's probably a lot harder to practice that constant, the repetition behind that. I caught the word that you mentioned of the portfolio of assets. So I want to pull that thread. Why don't you talk about what does that mean, and what does it mean to view your company as a portfolio of assets?
In some ways, it's really easy. You have, say, the old General Electric. You've got the medical product area, you've got the jet engine area, you've got the turbine area. That's pretty clear. It's a portfolio of assets. Or other companies that are conglomerates like that. It's harder when you have businesses that are very similar to each other, or maybe supplying each other, or maybe it's the way you go to the end market. To look at those as, those are actually pieces that fit together in a puzzle, but they don't necessarily have to be together in the puzzle. Maybe we can outsource, again, to use that example I have, part A. We can buy part A. So I encourage executives to look at their business as kind of like almost a mutual fund. They're moving assets in and moving assets out based on what has a better or a higher expected rate of return.
What's super fascinating, John, is like, I think a lot of people that I interact with in the privately held space get that concept, but it's very difficult for people to do that because of how the data is all muddied up together. Because like you say, okay, like when you talk about probably like the contractual relationships with vendors, like you were saying, like inter company, like they're supplying, the suppliers or manufacturers, supplying it to the distributor, and like having all that clean and accurate to truly see what the hell's going on in that particular division to figure out even how to price accordingly. What do we need for this thing? And so I think it's interesting that like it'd be like, do you find that when you're having these conversations, that data is very clear because of the size of companies that you're working with, so they understand like truly how to separate those puzzle pieces?
No, it's frequently very unclear.
Yeah. I don't like. Well, that's good to know that we're all in the same world, then, right?
Yeah. It's tough, but that's the ones that do it are the ones that do well. Frequently.
Yeah. So go for it.
Oh, you had asked about the type of divestitures, and I just kind of want to hit on that a little bit. There's lots of different types. I'm trying to go to an old slide that I have, but the way we talked about that one example, it was sort of selling. In that case, it was a facility, and the facility just happened to make part A that got sold back to the parent company. The facility could make different parts for different people, different companies, different customers, I guess you could call it. But there are situations where you've got big companies that do what's called a spin out. And it's a type of corporate divestiture. And so maybe you're a big company that's got all kinds of divisions, and you're just going to sell one division. And it is and always was a standalone business. So could be a spin out. If you're a publicly traded company, you might just spin it out to your shareholders, but that's a different type of thing. There's the whole idea of product line divestitures, which is a little bit of what we talked about there, where it's part of the bigger business, but we don't want to be in that product line anymore.
It could be like product line or a supplier, distributor. So business model and product line. It was the example, both of those, but it could be just a product line at the same time.
Yeah, it could be just a product line. Yeah, maybe we're a food manufacturer and we just happen to have, a protein line of business, but we really want to focus on our vegetable line of business. So you sell the protein line sort of thing. And what else? Well, full business unit sales, as we talked about, sort of standalone type businesses.
And the different reasons. I mean, when you're thinking about, I'm kind of going back to the reasons someone would do that. Obviously, like, hey, performance. Like your example is fantastic. Like that kind of popped up of like yep, makes sense. I have, and maybe a debunking. Like I see a lot of times where it's like stock manipulation. Where like I don't know if that plays into it. We're like, hey, like we're this is going to be our profits, or this is going on. We need to have this spun out, and we can then write it off against another division, or whether, because there's more like capital allocation and tax optimization too. I mean, I don't know how often that plays into a factor, or maybe not at all. I mean, I've just come across a couple of stories that I've heard like that.
The honest answer from my perspective is I don't see that. People don't say, hey, we need to divest this so we can write off some taxes. We don't tend to see that, and we don't tend to be part of that discussion. Maybe a little bit related to it is we are very much I shouldn't say involved in the discussion, but involved in the transactions where maybe a company got way too much debt. And they say, we're concerned that our business is going to slow down and this debt's going to be a problem. So they divest the unit and use that cash to pay down the debt.
Got it.
That's not quite what you were talking about, but those are situations that we see. And frankly, those are not always the funnest. We had one where they said, we've got to get this transaction done in 89 days or 90 days because we've got to pay some debt down. And we'd never done a deal that fast, but we got it done in 89 days for $105 million.
Go for it. Go for it.
Much rather take, 6 months and do it right and, but it worked for everybody in that case.
I can only imagine some of the conversations during that process. But why that was super helpful, John. So like one of the things that we talk a lot about is the Dave Deal, when him and I were on about the last episode, it was like growing intrinsic value based on the risk of the cash flow. It's like something that a company can control. And then when you're selling the business, valuations will, go way up or down depending on the purpose of the deal. So like starts at that financial valuation, but it might get a strategic premium because of whatever reasons, or a discount because of whatever reasons. But part of that process, John, is like for the seller to understand why the buyer wants to buy your company, or why they want. And so like one of the things that I think is fascinating is that you talk about that debt situation with that, the big corporation, or they're divesting it for the reason you talk about in the case study. It's very, I find it hard. I find it that people have a hard time. Like what's the enormous spectrum of reasons that this deal is happening? And like, it's so wide that like, because then you can figure out what does this mean for the buyer and the seller. Unless we know, it's difficult to understand. So I think it's interesting because like in that example of the debt situation, what would have happened if you guys wouldn't have sold? So what did the actual sale to them mean because of that circumstance?
Well, it could have meant a couple of things. The lender to that parent company could have put them in foreclosure and, closed the business down. Or at least called the loan, which would have been a big problem for them. I suspect they wouldn't have done that. They would have worked with them to try and find a way out of it, but they didn't. Yeah. And let me keep going on what you were just saying there, because we had a situation that I should say I often say I love talking about these situations. I suppose it's the ones that I don't talk about that I don't love talking about, so I don't talk about them. But this was a situation where I call it a mini conglomerate. The company was maybe it was $400 million of revenue, the parent company. So kind of a mid-sized company, but it was made up of about 6 or 8 different businesses. And they hired us to sell one business. It was roughly a $70 million revenue business, but not very profitable. Excuse me. When the parent company had bought it, it was losing money, and they did a great job of turning it around as best as they could. But, they had constrained resources. They just weren't that big. Mm-hmm. So they brought us in to sell it, and I think it might have been, let's just say it had very low margins when we got brought in to sell it. We ended up selling it to a private equity firm that is experts at taking good businesses and making them great businesses. And they actually had done that exact same thing on a company that looked very similar to the one we were selling. So not only did they know how to turn companies around, they know how to turn this company around. So they paid a price that we thought was unbelievably high. We thought, how in the world are they going to make any money on this? They came in, they made a bunch of changes, which improved the business, but they also got lucky because then there was a really high net worth individual who wanted a factory that did exactly what that factory did. So they owned it for 18 months and sold it for 2.5 times what they paid for it. So they made a ton of money. We sold it for a lot more than we thought we'd be able to sell it for, all because this company continued to get put to better and higher uses.
Super great story. And I think like the theme underneath that is there's the purpose of the deal that is on top. Like it's like this, it's part of the recipe when you have this intrinsic financial value, but then depending on who's owning it and running it, they can do different things with it, which will make more sense for each individual owner. And what I think is super interesting about all like these type of conversations too, John, is when we were having our kind of our prep call is like a lot of the listeners in here, their company works with divisions of these bigger companies too. So some of the things that you and I had talked about is like, first of all, it's important to know what the hell's going on with your suppliers or manufacturers or customers who you're working with, because I think a lot of times like all of those things that we're talking about from conglomerates and buying and selling the M&A of the portfolio businesses, a small business might only work with their customer or their suppliers. They don't know what's going on at the C-suite of these companies. Mm-hmm. So their interaction with their clients or vendors are impacted by those discussions, even though they might have a ripple effect down the road of how that all shows up. So that's the first comment. The second comment is that when you and I were talking prior to this, is like there might be an opportunity for a privately held business to be at the buyer table of these two to take their company to the next level too.
Yeah, absolutely. And they might be the ones that are nimble and know how to fix things and make things better, or have the time and inclination to go into new markets with the assets that the old company had but wasn't using in those areas. Yeah.
So who are the different types of buyers typically then? So you mentioned a private equity firm, but who are you, like, where are you finding buyers for these divestitures?
There are, in the general answer to your question, so outside of private equity or outside of corporate divestitures, I look at the world really as having two types of acquirers for businesses. And maybe it's simplistic, but then there's subtypes within there. The two types being financial buyers, which are either a private equity firm or a high net worth family office, let's call it. In other words, they're buying the business primarily for a financial return, primarily, not exclusively. And then there are strategic acquirers. And I define strategic acquirers as operating companies that are looking to operate more companies. And I did it that way very generally because a strategic acquirer might be in exactly the line of the business you're selling, or it might not be. But I still think of them as strategic acquirers. It's not exactly right, but the Washington Post I saw once bought a heater company. And I thought, why in the world did they do that? But I never did figure out why. But they did.
Because businesses make money, man, and they grow in value. And I'm assuming that there was some sort of like, hey, more EBITDA, more share price value growth, and whatever it might have been.
I might be off on that a little bit, but you'll see these oddball acquisitions. But I still consider them strategic acquirers.
Got it.
So but let's come back to private equity. You said what kind of buyers or what are the different types of buyers? Private equity 30, 40 years ago was kind of the boogeyman, and it was the Wild West. I want to be really clear in all the discussions I have, this one included. Private equity buyers can be some of the best buyers of businesses out there. They're very professional. This is the world they're in. They know what they're doing. They value their reputation, and they've frankly got a lot of money to put to work. But even more importantly, or maybe as importantly, private equity firms have realized over the last few decades that they're not going to make money through financial engineering. And they're not going to make money just by cutting headcount and cutting expenses. They come in, even as much as a strategic acquirer probably, and they say, we're going to buy a business and we're going to do things to make it better. And that's not a indictment on the previous owner that they didn't do those things. They were just busy doing other stuff maybe.
Or even a perfect handoff. I mean, like, you can get to a point where like an owner just says, I've done everything to this point that should have been done, but I'm just done. Like, here's the baton. I mean, it could just be that simple too.
Yeah. Now, this example that I'll run through here isn't a corporate divestiture. It was a private company sale, but it's a good example. Again, this was a privately held company. The guy literally started the company in his garage. I mean, it was actually started in his garage with one piece of equipment making this medical device component. So just a little $12 component that goes into a $40,000 device.
Yep.
But if you don't have that component, you can't sell a $40,000 device. So they had one factory. They graduated from the garage, had one factory, and it was in California, not far from a earthquake fault. And when we were talking to the buyers, they said, well, how do we get more business with our big customers? And, the Medtronic, Boston Scientific, those companies. They said, well, they don't want to give us any more business because if something happens to our factory, that can really impact their ability to sell this product. So, we don't want to build another factory because we're sitting here making good money and we're happy and everything's good. So we're just going to keep it as it is. And of course, the buyer, light bulb goes off in their head. I'm buying this company and I'm setting up another factory. And then I'm going back to the customers to get more business. They bought it. They did exactly that. So it ended up being an absolute home run for the family that sold the business because they retained part of it. And when that part they retained got sold later, it was worth as much as the main business to start with. And so it was, absolute home run for the buyer, for the family, and everyone involved. And it's a great example of a PE firm saying, we're going to make the investments in this business because we have a higher risk tolerance than a family who's doing just perfectly fine. And they don't want to take on that risk.
So it went from family business to private equity for a period of time to then the corporation that then was able to Was I following that?
I think it actually went to 2 or 3 different private equity firms, but now it's part of a bigger corporation.
It's super helpful, John, because like I think one of the things that like the lens that has helped me make sense of the whole M&A marketplace over the last 5-10 years is like everybody that's involved in this is trying to grow their business and create more cash flow and equity growth. Like that's it. So like as long as like when you're having these conversations, you meaning the hypothetical you, is like, where do I fit in that puzzle piece based on the players that are in front of me? Right. Mm-hmm. Like, cause like everything you just talked about, like makes sense. And I think a lot of the listeners in here go like, yeah, that makes sense. But trying to uncover that narrative is difficult. So how does someone figure out where this action's happening if like a privately held company wants to buy one or get involved? Like, how does that narrative, maybe it's just talking to someone like you. Does the question make sense?
Well, let's frame that back within the corporate divestiture, which is part of what this discussion really is. It is incumbent upon the executives, and we could be talking executives of $100 billion or $50 billion companies or $100 million companies, to say, are there aspects of our portfolio of businesses that we should consider divesting, and other things that we should consider acquiring? Mm-hmm. Now, that's really hard because they're busy making decisions about personnel in the last couple of years, how to operate during a pandemic, real estate, all these different things. But I would say this is one of the things that also needs to be on your plate as an executive. If you're unsure about the ability to, can I get this thing sold? Ask somebody. Ask us. We'll be happy to talk to you about it. And, I've got 2 or 3 on my desk here where, frankly, they came and they asked, and our answer is, can't help you for various reasons. Mm-hmm. So we'll give you the honest answer. Mm-hmm. I would much rather say, I can help you, and here's how we're going to do it. But, got to give the honest answer.
So when you're looking at someone, honestly, either on the acquisition side, so like the bigger companies that you're talking about, the on the acquisition side or the divestiture side, and if I'm pulling on a thread that doesn't really exist, you could just go ahead and tell me. But like exactly, cut the invisible thread that I'm trying to grasp at. So there's been a couple people on the podcast, John, that they were investment. One was he was the head of corporate development. So for the listeners, the M&A division of one of the bigger companies, and then he became an investment banker. And then there was another gentleman that kind of plays in the space, and both of them, his name is Ted Schluter, and then I can't remember oh my God, mind blank on the other podcast. But the point is there was very micro situations going on where the executive at the firm was like, my bonus is based on like this division and the crap that's going on. And they had lost 2 bids. So he's like, I'm going to pay whatever I need to pay because I need it for the company's strategy and my personal bonus along with their team. So there was like truly like really nuanced things kind of driving the deal. And both of those episodes, there was kind of like an underlying story there that like, it's kind of just like there's the corporate strategy, but then there's the individuals that are just people, right? That have bonus plans and comp plans and stock options, where like, it's kind of trying to, the thread that I was pulling is like, what's the purpose of the deal? And like, these are just nuanced things that actually are real. And I think it's just so basic that people kind of don't put a lot of merit on it, but I'm like, that drove the whole deal. And like the numbers for that guy or gal was just, they're selling a $70 million division or buying an $80 million one, and the division's actually $10 billion. So it means nothing to them, but it's generational wealth for you. So there's like this mismatch of reality and perspectives, but it's just another human being doing a job. And I don't know if like I said, you can cut the thread or like, I don't know, provide some context or color to it.
It reminds me of one of the discussions I had in grad school with our professor, or I don't know, but he said something along the lines of, when you have interactions, you're not interacting with ABC Corporation, you're interacting with a person who works for ABC Corporation. Never forget that it's people that make these decisions. But coming back to the bigger, I think part of what you were saying there is that it's important when a corporation sets up their comp system to make sure that it can't be manipulated in ways that you don't want it manipulated. Mm-hmm. That might not quite sound right, but if your goal as a corporation, unless you're a B corporation, it should be your goal, is to maximize shareholder value. Lots of ways to do that. And So you want your people to make sure that they're doing it. They're doing things to maximize shareholder value.
Mm-hmm.
We could get off in all kinds of tangents about what the right ways to maximize shareholder value are.
But I think yeah, let's go ahead.
I'm a Milton Friedman guy, so let's just leave it at that.
Your story about the people are people. I think that was just perfect way to put it, because that you name the company, their incentives, whether they're right or wrong, are driving the people, and you're having a conversation with a person. So I think it was very, very insightful. How are these, like the pricing of the value, whether they're divesting or acquiring, maybe walk us through how they're thinking about value. Like, how are they approaching the valuations when they're divesting of these, like, in thinking about it? Is in terms of why they need to divest of it? Are they looking to the open market and comps talking to you? How do they get to that conclusion?
Well, I'm glad you brought that up in the context of the discussion that we just had, because I want to give an example of a situation. We were working on a divestiture for, let's just say it was a very, very large Japanese company. It wasn't Toyota, but it was that size company. Okay. And the divestiture was so small. And at one point I was saying to them, heck, we could push in this area to get a little more value. And the guy finally said to me, he's become a good friend, and we've remained friends for 10 years. He said, John, the value doesn't matter. The only thing that matters here is that we get this deal done and we have no liabilities going forward. And well, holy moly. And this is a $40 billion company. And the divestiture was maybe I don't know, it was really small, $5 million divestiture.
To the right of the decimal point of everything else that's going on.
Exactly. So it was important for me to realize, oh, that's right. I'm so used to trying to maximize shareholder value, but his goal was to minimize legacy liabilities. So that enabled us to structure the transaction in a whole different way, so that the buyer the buyer was a small business. This mattered to them. Mm-hmm. So they were able to get a good deal from their perspective. The seller was able to get a good deal from their perspective, but the valuation was just a secondary concern. and at one point, this is a little bit of a tangent, there was a supplier to this business that was being very difficult in the negotiations. And I said to them, why don't we just crush them? We can tell them they're cut off. We're going to go somewhere else and supply, and buy this stuff. They said, here in Japan, and I might have this a little bit wrong, and I don't mean to put an entire nation into one category, but he said, we live on an island, and it's pretty crowded here because a lot of our island is mountain. You can't live there. So it's important for us that we learn to have harmony and kind of get along with each other.
That's the Japanese culture in general. I'd say that's
from what I've experienced. He said, we're the lion here, and they're a little rabbit. We could just swat them if we wanted to, but that's not the way we want to operate. So anyways, important. That's kind of my example of important to know what the people making the decision really are looking for,
which is super helpful. So again, I think as I'm continuing to track this conversation, is the nuances are so important to understand really what is the purpose and the intentions of everybody at this deal table. So if someone, maybe here, more of a general question, how many out of the deals that you do, John, are super nuanced like this? Is how they're pricing these versus like discounted cash flow, market comps?
All of them are super nuanced. All of them.
So helpful, John, because again, it just continues to because here's the philosophy I keep preaching is, if it's a financial value, you can almost pre-engineer the valuation if your expectations are in line. But if you're going to whether for your ESOP division, right? People can grow value, sustainable, predictable, transferable value. They can monetize the asset, and it's a financial value, like you said, like a financial buyer. And then you have the third party sales, and it's all in the nuances. There is a financial value, but the nuances are so darn important in that conversation. Otherwise, you're kind of like mismatched for the conversation of how to even determine that value.
Well, as we say, we let the market determine the value, but we give the market the information it needs to determine the value from their perspective, which is also to say we push them very hard to come up with their best offer.
What are these corporations looking at for like deal structures, John? Is it like give me all cash? Because I'm assuming a corporation doesn't want an earn out or something like that. So like what are the typical deal structures?
I'm going to come back to that question, but I want
Okay.
to kind of give an example from a discussion I had last night with somebody. And this is important where it's really understanding what the buyers are looking for and the sellers are needing to achieve. This is a real estate question, so it's not a deal question so much, in my world. But this company was looking to get out of their lease. The spot just didn't fit them anymore. And they realized, wow, that's $1 million payment we have to make to get out of this lease early. And they're like, it's tax deductible. Let's go ahead and do it. And like the next day, they get a phone call from this big company whose name everybody would know that says, we're looking for some more space, and you've got exactly what we're looking for. We'll pay you $1.5 million to take over your lease. And they're like, okay. So it's important to see what all the different perspectives are out there. Uh-huh. And before that, I mentioned that all deals are nuanced. Earlier in this discussion, we talked about the company that was over levered. They had too much debt. They needed to get a deal done to pay down the debt. Mm-hmm. That had to be an all cash deal at close, mm-hmm. and it had to be done with a party that we were confident would have the cash at close. So pretty straightforward there. Mm-hmm. The small Japanese divestiture that I talked about, again, money didn't matter to them.
Because it was the liabilities that they wanted to get rid of. So I'm assuming they wanted to sell the stock, get rid of that entity or whatever the hell was going on so they could limit their liabilities was the main concern.
Yeah. So I had this whole structure all talked about where it was going to be, an earn out based on EBITDA or revenue growth and all these kinds of things. And they're like, just go back to them and find out how much cash they have available and we'll take it. So for them, it was, it had to be all cash, but it had to be done with no liabilities.
Right. So go ahead.
Corporations usually want cash.
I was going to say, man, I can't imagine a division of a bigger company being like, hey, we're going to do an earn out with this and that and getting all pretty. They're like, no, this has got to be pretty straightforward. Just my thought, or maybe a seller financing if possible. I mean, I don't know if you see that.
Yeah, on the bigger deals, again, we work on call it $100 million and below. Sometimes it's bigger than that, but in that range. Mm-hmm. On those, you tend to not see a lot of structure. Structure meaning earnouts or seller mm-hmm. financing or something like that. But on the bigger deals, you do see that sometimes. Maybe I think it was GE sold a division. I'm losing track of it, but they retained 48% ownership of the division because the buyer just couldn't afford to buy the whole thing. So that's the way they structured it.
Super cool. Is there thinking more, and if you can put a pin in this question, if you got a couple other topics you want to cover prior, but my question on the kind of the macro trends of where we're headed, John, is, with a lot of corporate debt that's been just consumed and gobbled up over the last handful of years. And I know there's been a lot of free money floating around too. Do you see, I'm trying to think of how to articulate this. Do you see more corporate divestitures in the future where there could be an opportunity for privately held businesses or smaller private equity firms that are looking to take advantage of maybe some better prices, or people that are trying to, right size their infrastructure and stuff? So kind of a 1-2-part question is do you see more divestitures, or is there maybe more acquisitions because of the slower growth period that we're getting into with higher interest rates, where these corporations want to then do more inorganic growth? So it's almost what do you see more of, kind of based on the conversations you've been having and the trends?
I would like to think, and it sounds self-serving because a little bit of it is, but I would like to think that corporations would continue to, and even increase their frequency of saying, how do we right size our portfolio of businesses? Mm-hmm. Which is to say, close things down, divest things, maybe acquire things. That comes back to the whole discussion at the beginning of viewing your company as a portfolio of assets, mm-hmm. that you have to manage that portfolio and be investing in things that have a high rate of return, or at least a higher rate of return than your cost of capital, and be divesting things that have a lower rate of return than your cost of capital, mm-hmm. or things that occupy a lot of your mind and people, and you just don't have time for that. Mm-hmm. I'd like to see that. And I think one of the reasons that it can continue to go that way is because there is so much other money waiting to be invested. the private equity money.
Mm-hmm.
There is somewhere around $1 trillion of equity waiting to be invested. And that's only half of the story, because a PE firm tends to buy a company with about, nowadays, half debt, half equity.
Yeah.
So it's $2 trillion of
purchasing
power.
Yeah, right.
And wouldn't it be great if all these businesses, all these big companies that had units that are inefficient or not core, put more effort into getting that in the hands of some person or organization that's going to work hard to make it better?
Amen, John. Honestly, I hope cause I don't have any dog in the fight for that one, but like, I agree with you, because I've watched, shareholder value. I think I track you. It's just shareholder value that's actually based on freaking cash flow, not stock manipulation. So like, I've watched over the last 5 to 10 years, man, like people doing things with their companies, like the bigger corporations that are public. And you're like, dude, you're just manipulating your stock price so that they're buying these different entities and like inflating their stock for whatever bonuses they got, to your point. And I would love to see the return of these acquisitions, the actual return. Because I think there was a stat that I saw out there, John, that 80% of acquisitions never exceed their cost of capital. I'm sorry, it's generally more expensive to buy a company than just using your own capital that you could use to borrow off of, because they don't integrate it correctly. It's so off from what they were doing. And I think we've just seen even more of that. And now we're starting to see J&J is trying to break up. Like there's people, EY is trying to break up. So you're seeing these people going like, what the hell are we doing? Like we need to make money at the things we're good at. So I'm starting to see the bigger companies trend, and I could be wrong, but I'm just kind of like my observations from the Wall Street Journal and some of the bigger publications. But it's interesting watching then people then say, okay, we actually don't, what business are we in? And I think there's more of that now than, hey, we should be a holding company of everything.
The comment that you made earlier about 80% of acquisitions don't add value. That's it. And I'm not sure if that's exactly the number I've heard.
Me neither. It was an anecdotal comment that I heard from someone.
But if you put yourself in the seat of the corporate executive, or the line executives who have to make decisions about, am I going to go build a plant? Am I going to hire these people? Am I going to put $1 million into, or $100 million, whatever it is, into a marketing campaign? What are these things? You have to make these decisions. And let's just say if your only two choices were to buy a business or to spend more marketing. Well, what's the old adage about marketing? Half of your advertisement is useless. The other half is great. You just don't know which half is which.
Yeah, right.
So there's a lot of situations where you've got to make decisions with imperfect information. And
fair enough. Yeah, it's not an easy decision. It's not clear.
Yeah. And what is clear is that the companies that are actively managing their portfolio, and I've used this term, a half a dozen times on this call, buying businesses that fit and that accentuate what they have and divesting things that don't, those companies tend to outperform in the stock market. And they don't outperform because they're active buyers and sellers of businesses. I don't believe they outperform because the fact that they're active buyers and sellers makes the underlying business a better business, and it generates more cash flow for lower risk.
Yeah, they got the right intentions the whole time, right? They actually focus on the things that are actually growing value and just constantly tweaking the machine instead of just hoping that like what they did was the right choice, right?
Yeah, totally. Yeah.
So I know we're getting close to the wrap up here, John. I mean, I know you do these presentations quite a bit. Is there anything that we haven't covered that you would like to make sure that we cover?
Well, I'm actually looking at some notes that I wrote down here. There's a whole section of topics that we won't go into here, but I'll just say that when you're doing a corporate divestiture, there's all these considerations that frequently don't come into play in a company sale. So if you're going to do a corporate divestiture, make sure you have a team that is knowledgeable about the specific things that happen within a divestiture. Just as an example, when you're separating a business unit, maybe the company that's being sold or the unit that's being sold might not have all of the things that a normal company has, like a phone system, an
HR, payroll,
HR, financial statements. So there are a lot of things that you have to keep track, that you have to think about in a corporate divestiture that you don't have to think about nearly as much in a regular company sale.
So, I mean, great point. And I think also, like, I know that significantly impacts the price that people want to trade on, because like, are we including all that infrastructure or not? Right. I'm assuming the buyer will dictate, well, do you need to account for that, or do they also have that, or you can just bolt it on? I mean, I'm assuming you're having those conversations quite a bit.
Or do we go out and find someone that can supply it to us? Yeah, all kinds of questions.
Right.
And they're all different for every transaction. There's some fundamental things, but things vary quite a bit. Yeah.
That's awesome, John. Well, I'll tell you what, I very much enjoyed this conversation, and I usually wrap up with 2 questions. The first one is best place to find you, Prairie. What's the best place?
Yeah, so we're Prairie Capital Advisors, as I think we said at the beginning. The website is prairiecap.com, and there is a private equity firm named Prairie Capital, so make sure you get the right one.
Wendy has corrected me on that before, so thank you, Wendy.
Yes, yeah. There was a second question.
So I love to hear what people's definition of intentional is, John, because it's the name of the show. And when we renamed the podcast like 3 years ago or something like that, I've been asking everybody, and people's definitions and how different they are is just a very personal enjoyment, a personal kick of mine. So any thoughts of what the word intentional means for you?
Well, sometimes people kind of just sit back and let things happen, the old French laissez-faire. I think intentional has to do with saying, okay, what is the domain that I'm operating within? How do I get the knowledge, develop the knowledge and the skill sets to operate within that domain? Then set a goal and travel down that path to get there within the domain knowledge. So it comes down to a lot.
That was awesome.
What I call domain knowledge, yeah.
Yeah, the opposite of laissez-faire. I love that. That's awesome. I've always tried to figure out what's the opposite of intentional. It's like chaotic, and I've just not ever landed on something. So I think you just filled that gap, man. I love it.
Expanded our French. Laissez-faire.
Yes. John, thank you so much for coming on the show. I very much appreciated it.
Well, Ryan, I really appreciated this too. Hopefully people found it interesting. It's one of my favorite topics to talk about, and look forward to continuing our discussion.
Yeah, you gave us a view inside of the mindsets that a lot of people don't get exposure to, so it's very, very helpful.
Yeah. Wonderful. Thank you, man.
I hope you enjoyed that interview with John. What an interesting perspective. And I just love the fact that we can break it down and demystify things that are happening every day. People talking about value creation. What is the share price? What is the equity growth of my business? Whether it's an employee who's trying to sell a division of a bigger corporation, or whether it's you trying to grow the value of your company, it's the name of the game. And by understanding that this corporate divestiture world exists, I think it can help everybody listening in to seize opportunities or to avoid catastrophe if there's a divestiture of a company going on that you are highly reliant on. It's going to impact your business. And or if you get your stuff together and you get your financials built and you understand where you're at right now, you could maybe buy one of these companies if they don't care about the price, and you can bolt it onto yours and actually have a creative value creation right off the bat. So interesting to just pay attention to regardless. And my suggestion would be is that if this stuff interests you, go check out the Intentional Growth Bootcamp. It's at arcona.io. It's $5,000. It's for 2 days, May 11th and 12th in Orlando, Florida at Rollins College. Wonderful for partners, for team members and executives to get on the same page. And the goal is to clarify the target equity valuation and figure out how you're going to go get there, balancing the reinvestment versus taking the money out and making sure that's all tied to the long-term plan. So go check it out, arcona.io. And I appreciate everybody tuning in, and I will see you next week.